Okay, Chair Reed. All set.
Thank you. Good morning, everybody, and welcome. First day of spring 2026. And here we are, so this is a good thing. I'm going to call this meeting to order at 9:01 a.m. And first, let me ask, are there any public comments? Okay, hearing none. Let's go to item number 3, the consent agenda. Brian, you wanted to talk about that initially? I know there are minutes.
Yeah, we have several meeting minutes for approval, including the regularly scheduled January 16th meeting and then the special meeting of January 23rd. So those are resolution 1. And then we have several report outs, including the staff approved transactions, which we didn't have any. And we have the staff approved restructurings or write-offs, which we had 3 of them. These have to refer to our Solar Lease 2 program, where members of the board might recall we did some 1,200 residential solar loans, or excuse me, solar leases. So the 3 projects here have to deal with various things from squirrels to deaths in the family to, those sorts of things. So we wrote off 3 of those transactions. And then we've got our Q2 of FY26 Inclusive Prosperity Capital report out. So resolution 1 is on the docket for approval.
Okay. Does anybody have any questions or observations? Do I hear a motion to approve resolution 1?
Is it possible to recuse from the January 23rd? I wasn't at that meeting. That's why I'm asking.
Yes.
Okay.
Definitely.
I was at the January 16th meeting, so just the January. I don't know how to, if it's one resolution.
Yeah. How do we do that, Brian?
I think you can.
Brian Farnham there.
Yeah, let's see. Brian, you there? You can. We'll still have the approval, Kim. We can do them separately. Yeah. Why don't you just abstain and let's see if the other members of the board are okay.
Okay, sure. Okay, thanks.
I so move that the consent calendar be approved.
Thank you.
Bueno, second.
Okay. All in favor?
Aye.
Opposed? Abstaining?
This is Allison. I will also abstain because I wasn't there.
Okay. So
for the January 23rd only.
Okay. So are we taking that in 2 parts, Brian, or?
We're still okay. We have the ability to move them forward. We'll just note the meeting in the meeting minutes that Kim and Allison abstained for the not being there.
Okay. So moving on, so the legislative process, get an update on how smoothly it's going. So James is there with you. Do you want to talk to us about that?
Yeah, sure. Thanks.
Process.
Thank you, Chair Reed. Good morning, everyone. James DeSantos, I'm the legislative liaison here at the Green Bank. Just wanted to give you a quick update. We are officially now at the midpoint of the session, so we're about 6 weeks in, which means there's chaotic 6 weeks left. So I jammed 6 weeks of chaos into 4 slides. So if there's any questions, if you hear anything in your districts or in your groups that you circulate in, have any questions on any legislation, just please reach out. You can hit me up via email or on my cell phone, which is in my email signature. So the 2026 legislative session started February 4th, adjourns May 6th. This is the most compressed short session in the history of the state of Connecticut. When I wrote this, it was nearing the midpoint. Today is actually the midpoint, and all the committee work at this point has, for the most part, been concluded. That means all the proposed bills, the public hearings is pretty much done. Just leaving open a few a few committees, appropriations and finance, right, which are always the last two because they're budget related. Finance ends on April 2nd. So then what happens at that point is it goes into the negotiation phase, and then you start having the full sessions. So you also have the committee referrals where a lot of amendments start coming into play. So the pace of the session definitely picks up from this point on. So what's driving the discussion in 2026? It's two things. It's affordability and elections. So in 2025, we know a lot of the discussion was focused solely on the affordability of electricity rates. Fortunately for the Green Bank, that has broadened this year. The discussion on affordability has permeated housing, business, healthcare, wages, college tuition, public transit, income taxes, property taxes, you name it. Everything is based upon affordability, and that's all tied directly to the fact that it is the middle of a gubernatorial, state senate, and state house election year, right? So it's an opportunity to get your campaign messages into the sphere. Another key element of this too is there's a lot of legislative retirements have started to occur, which poses a very interesting thing. It's either a swan song or it's a drop the mic. I'm getting what I want to get this year, and I don't really care. So it's we're seeing a lot of bold movements, which is playing into it. Very interesting.
Is that,
So yeah,
can,
go ahead, Lionel.
I just want to ask you, is that, because that kind of limits the quid pro quos, right? Are you noticing that? I mean, when they know you're not going to be here next year.
Yeah, 100%.
They can wander away. Yeah.
Yeah.
That's sort of like, yeah, what do you got for me? Yeah.
Exactly. What are you going to do for me? Yeah. Yeah. So that more and more are starting to drop. I think we're probably around like 12 already at this point. So the session by the numbers. So currently the Green Bank is tracking 81 pieces of legislation. We submitted written testimony on 5. And we testified live in support of 2 pieces. So what we're entering now is the negotiation phase of the legislative session. So you can go to the next slide. So even though we're tracking 81 bills, I just wanted to highlight 2 that I thought were the most relevant, most important to everyone on this call. The first is Senate Bill 416. So this is the opening of the Clean Air Act from 2022, and that concerning system transportation modernization. It's a transportation bill. A key sections within that bill, sections 3 and 4, pertain directly to electric school buses. And Kevin Moss and Sarah Harari have been exceptional in the preparation for this bill, knowing it was coming out. Sarah and Kevin met with the chairs of education, environment, transportation. They also met with CAPE, which is the Association of Boards of Ed, and CASBO, the school board officials, and the superintendent of schools, which is CAPS. So they were able to get a consensus on language that everyone could agree to before the legislative session started. So when the language came out, it incorporated all of our changes to the electric school bus and to the Clean Air Act. What it did was highlighted here is the distressed municipality. The language was clarified. Originally, it was environmental justice communities in whole or part thereof. That was just streamlined to say distressed municipalities. There is a clear overlap between the two, but what it does is it tells which municipalities need to move by what date. There's a 10% electric school bus deployment by 2030, 50 by 2035, and then 90 by 2040. They're all required to submit a plan by 2029. And then if you're non-distressed, it's 100% electric school buses or alternative fuel by 2035, 90 by 2040. The key part to the alternative fuel is House Bill 5470, which you can see at the bottom of the slide, which is a House Republican caucus bill. Is really pushing forward on the alternative fuel buses, such as propane, to be utilized. So elements of that were incorporated into Senate Bill 416. So that bill has passed out of committee as we went through the process. We can go to the next bill, unless Brian Farnan is on and has anything he wants to add to that. Is he on? He's on. He's on. Brian, I wanted to just open it up.
No, you're doing a great job. No, you just
Okay.
keep moving.
All right. Go to the next bill. So this is the Energy Omnibus Bill of the 2026 legislative session. This is Steinberg's pride and joy. Steinberg is the co-chair of the Energy and Technology Committee. It passed out of committee yesterday in E&T. It passed out as a straight JF to the floor, so there was no substitute language, which means this bill will be negotiated very heavily over the next 2 weeks as a strike-all amendment, which will be offered on the floor. It is what the bill essentially does is it takes the work that PURA did over the past year on the successor study, which is PURA docket 250214. It served as a baseline for successor programs. So the key elements of this is sections 1 to 3 in creating a framework for the successor programs to RRES, NRES, and SCEP. Brian Garcia and Sergio Carrillo were both there to testify at the public hearing. It gives us, the Green Bank, an opportunity to really advocate for items that we feel are important. It's the prioritization of paired solar and storage, not just utilizing storage, but pairing that with solar to address the duck curve at the end of the day, help out the finances for the scalable deployment of renewable energy. It's also a prioritization for the shovel-ready interconnection process, which as we all know in this energy space, the biggest hurdle to overcome is the interconnection process with the utilities and the time lag that is associated with that. There's an ongoing debate on the cost of the program. Opponents are saying that this will cost, I think, to the tune of $11 billion over 20 years. So there's discussions on how the pricing for this successor program should be, whether it's administratively set or it's a reverse auction, a competitive reverse auction like exists now. We made a recommendation for the multifamily affordable housing, suggested expansion to include apartments, senior living facilities, student housing, and mixed-use facilities into that bracket. And also, a lot of people have spoken to the eligibility of fuel cells to participate in successor programs because they have such a high capacity factor and can be incorporated in such a small space. Senate Bill 4 from last year removed that. So there's been an effort to try to put that back. Section 4 is the extension of the Solar Consumer Protection Task Force. This would be the third extension that has been made to the Consumer Protection Task Force. We made an appointment 2 years ago. It has failed to get off the ground. Last year, they amended it, extended it out, still failed to get off the ground. So this time, third time's a charm. It's going to go through. We have an appointment to that, and it will proceed. Plug-in solar or balcony solar is in Section 5. There's a lot of concern, a lot of pushback from the utilities on the safety elements of this section. This allows a homeowner to install, I think, 1.5 watt
Renters.
Yeah, renters to install, and it's a plug-in solar. The concern, it doesn't require interconnection, but the fear is that it would somehow backfeed the grid and what other safety concerns may be out there. So that's likely to turn into a study this year, which means it'll be a full-blown bill in 2027. Section 6 is deep to develop and implement a program to support agrivoltaics. Agrivoltaics is the incorporation of agriculture into photovoltaic layouts by 2027. And then Section 7 is deep to develop a 2-year pilot program for residential solar and EJ communities for little to no cost to up to 100 households. Key part to that is it's within available appropriations. I know Deep, and I know Joe DiNicola is on the call if he wants to comment further on this one, but I know Deep was opposed in the very high level concept, saying, questioning how this relates to the SCEF program and the end goals. But I'm sure this will be negotiated as well over the next 2 weeks. So if there's any comments, we can go to the last slide. And just to wrap up on PURA update. So we've touched upon this slide several times. So there are 5 commissioners that are currently operating at PURA right now. One has been confirmed by the legislature. That's David Arconti. The other 4 are moving through the process as House joint resolutions or Senate joint resolutions. They all went through a public hearing and committee meeting on March 5th. So now it requires a full vote by the House and then by the Senate or vice versa. So the House is expected to go in on March 25th. So we expect to see Janice Beecher and Holly Cheeseman confirmed during that time. I just wanted to throw the votes were each one of them passed 18-2. It was not a confrontational hearing at all. The same two people voted against all four candidates. So it was a very smooth process to date. So it wasn't like in the past. I think that's the last slide. So if anybody has any questions, please let me know. And if you think of something later on, please send me an email or give me a call.
Hi, this is John Harity. Just a comment that renewables, you never know how things are going to go because renewables now become more favorable thanks to the adventurism in Iran and the Middle East, which is driving oil up substantially.
That has actually contributed greatly to the argument of using domestic energy, right? So that's actually been a boon. And yesterday, Senator Needleman spoke for about 15-20 minutes on that specific point. So if anyone has a chance to listen to the E&T committee meeting yesterday, it was Norm Needleman's statements on 5340 were fantastic. Speaks to your point, John.
James, Lisa has a question.
Lisa? I think your mic's off.
Yeah, go ahead and chat it through, Lisa. See if we can. See the chat. Yeah, chat it through. It looks like you're typing away. Go ahead and type. You're all right. We got you. Sometimes the mics don't wake up on the wrong side of the laptop. I guess I would just say, while this is typing, the other side too is, as we've all experienced a really cold winter and the high utilization of natural gas prices, the nuclear power plants and the long-term contracts really served as a hedge to our electric prices this year. So on the other side of your question there too, John, nuclear has had a big benefit. Okay, there you got that, James. You want to read the question?
Yeah, the question from Lisa is, I have a question about the leaf blower statute raised. It seems that the Connecticut Green Bank is suggested to give loans to commercial landscapers. Any update? Yes. So Senate Bill 319, it's an Environment Committee bill. Initially, it called for a ban on the purchase of gas-powered equipment by several several state agencies by a certain date. But to your point, Lisa, Section 3 specifically called out the Green Bank to create a loan program to raise low-cost capital for commercial landscapers to purchase or make the conversion from gas to battery-powered equipment. So this is a very, very heated debate that's going on right now on this, Lisa. So the environmentalists have sort of positioned this to be their number one issue this session. Out of all the issues that are out there, it's the climate. They have the Climate Super Fund is out there, the Climate Resilience Fund, a lot of other issues revolving around energy and plug-in solar. But this is the only one that the advocates reached out to the Green Bank to me specifically to discuss this. So when they passed JFS language out of committee, which is substitute language, it amended the bill, and what it did was it removed all the bans from the legislation and then left Section 3 in there for the Green Bank to create a loan product by, I believe it's January 1 of 2028 for low-cost capital to commercial landscapers to acquire equipment. So we have a meeting with Lopes, Senator Rick Lopes and Representative John Michael Parker next week to go into exactly what they're looking for and see how the Green Bank can help.
And then just a follow up to James. one of the things we've committed to doing, to looking into, one is on the Smarty loan side for single family homeowners. Many board members might recall that we had an up to 25% of the principal value of a loan can be used for Energy Star appliances. Why only up to 25%? You know, the appliances aren't permanently affixed, so they could be taken out of the property. So we had that provision in our program for years now. Now, just given our experience, they're just allowed. So we would work to include an ability for homeowners to, finance their own leaf blowers, lawn mowers, electric lawn mowers, whatever, through the Smarty loan. So that's one thing we've committed to do. And then the second, on small businesses that are trying to finance their lawn mowers, we've agreed to speak to our Smarty loan lenders, their small business lending side of the operation, to discuss what that looks like, because those small businesses are risky. You know, the lending there and the security required would be significant. So, you know, as we're all looking at all these different trade-offs, you know, Green Bank is wants to be a solution, but we do have priorities in terms of, you know, reaching multifamily affordable housing with our solar and storage programs, you know, opening up the electric school bus market. So it's just a matter of, making sure our people side of the equation is being managed to the overarching priorities. But outside of the policy, those are things that we flagged that we'll be looking at in FY27.
Great. Is my microphone
Yes,
working
working.
now?
There you go.
Okay,
We
good.
can
I
hear
think what
you.
happened was I was looking at the legislation and on my phone, so it didn't work out. Well, thank you for that really extensive response. I appreciate it.
You know, this is Lonnie. I just have to say, so we just had this come before our RTM this week, and it was a disaster. And they shut it down finally. It filled up, the meeting filled up with lots of angry landscapers who don't want to go there yet, because it's that apparently the electric version is much more expensive in a commercial enterprise than it is, locally. And then a lot of local folks showed up. They just don't want to be told what to do. I mean, it was wild. 2 nights they had to have it. And finally, everybody said, nope, we're not doing it. So I can see, us being able to help, make it a financially attractive experience would be a good thing. Also, some of the people who testified, which was pretty stupid, were going to make money from it. So they were attached to some of the commercial landscaper companies that were going to be the commercial, equipment companies that are going to be selling the stuff. And they're also landscapers, but they also have an economic interest. So ka-ching, ka-ching, and that blew up. So it's hopefully the proponents are learning some lessons along the way on how to, phrase this and pitch it.
Yeah, it's a really difficult thing. We did pass a leaf blower ordinance in Norwalk. I was the chair of the ordinance committee, so it was my pleasure to take all of those incomings. It's really,
Yeah.
It is very controversial, but there is just a lot of myths out there about how the electric equipment isn't up to snuff and things like that that really aren't true, but it is really important to phrase it right. So anyway, we won't want to take too much time on this today, but I really appreciate you keeping me up to date on it, as it's very interesting to me. Thank you.
Thank you. Okay. Have we finished with the legislative rundown, James, or is there something else?
All set.
All set.
Okay. All righty. So let's move on to investment programs. What's that? Somebody's talking? Oh, okay. So we're going to move on to Item 5, investment programs, and we've had lots of interesting activity with our investment programs. And so I think it's Bert and Mariana are going to talk about 5A, solar and storage. Is that right?
Yeah, actually, Mariana will take the lead here. What we're doing is we're asking permission to set up a couple of new special purpose entities, and Mariana will explain the need behind that.
Great.
Over to you, Mariana.
Mariana, you're on.
Good morning, everyone. My name is Mariana Treef, and I'm a director in the investments team. As Bert mentioned, we're coming to the board to seek approval to form new subsidiaries to support solar and storage project development and long-term ownership. The goal and the reason why we're coming to the board is to better align our structure with project life cycle and some of the risks that come up during that life cycle. So today we have mostly two different entities, Cephia Holdings and Cephia Solar Services. Cephia Holdings houses multiple types of assets, including development stage projects, operating projects where we're the long-term owner, and also loan portfolios. And Cephia Solar Services is a taxable entity and supports some of our ITC safe harboring activities. The reason why this is problematic and why we're proposing a change is because we have some commingled risk exposure, especially in the Cephia Holdings level, some sort of limited structure clarity, and we're seeing some challenges as we scale the pipeline. Effectively, we're mixing sort of development capital risk with long-term operating assets and financing risk in a single entity. So what we are proposing, if somebody can go on to the next slide, is to create two new wholly owned tax-exempt entities. It's the entities we're showing in blue. It would be a development entity that will handle all of the, again, for our solar and storage projects, all of the development, permitting, interconnection, EPC contracts, basically everything that happens at early stage and during construction of projects. And then the ownership entity would house and handle all projects that are already operational, post-construction, operation and maintenance, and sort of the long-term management of our PPAs and lease contracts. And again, the key here is we are to improve our risk segregation by having separate development and construction entities from long-term ownership. So how that would work is that projects as are being developed would be owned by this development entity, and they would be moved to an ownership and to the ownership entity somewhere around mechanical completion. We might also we also intend to reallocate projects that we currently have both under development and under ownership to each of these entities to align with this strategy. Cephia Solar Services will remain in place for any safe harboring ITC strategy. That's a tax-paying entity, and there's sort of some nuanced rules about safe harboring associated with tax-paying entities. And Cephia Holdings will remain in place as a disregarding entity, acting mostly as a lender, but not as a project owner and not involved in project development. If we can go on to the next slide. This just summarizes what I've been sharing about the current role of the entities and how that will change after we create these two additional entities. And again, we're suggesting this creation of two new entities because we think it'll manage risk better. And it's just clear from a governance perspective, and it aligns with market best practices and many of the things we ask our borrowers to do when we're a lender in this space. This also supports sort of scaling of the pipeline and gives us enough flexibility for our solar and storage development and any potential future technologies. So just to sum up, and if we can go to the resolutions, we are requesting authority to form these two new entities and for staff to be able to move ahead with implementing whatever's necessary to both create the entities and implement the structure, which includes transferring some of the assets to each of these entities as appropriate, depending on where they are in life cycle. And with that, unless there are any questions, which I'm happy to address, I ask that you approve the resolutions.
Does anybody have any questions or observations, concerns? This sounds like a really smart move. So I hear no questions. Do I hear a motion to approve resolution 2?
Motion to approve, Adrian.
Thank you, Adrienne. Do I hear a second?
Second, it's Joe.
Thank you, Joe. All in favor?
Aye.
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 Opposed? Abstaining? Okay. Excellent. Moving on, let's see, 5B, Fiona and Christina, I think, are going to talk about that.
Yes. Good morning.
Good morning.
And
Hi,
say
everyone.
before we get started, I just wanted to just a preliminary introduction here, that we have a couple of transactions for Capital for Change, their facility modifications and extensions. So one's related to the multifamily facility, which is up first, and then we'll get into the other one that relates to support for Smart E. So yes, thanks, Fiona. Sorry to cut you off there. I just wanted to give some introduction there. Thank you.
Great. Thank you. I'll start off with a quick overview on Capital for Change for those who might not be familiar, but Capital for Change, or C4C, they are the largest full-service CDFI in Connecticut, serving people, nonprofits, small businesses, and public institutions. They're focused on providing access to affordable housing, energy efficiency, and opportunities for underserved communities. And the Green Bank has had a longstanding relationship with C4C on a number of different programs. As Bert mentioned, we're coming today regarding the Lime facility, and then also CFCO or Smarty. In terms of the Lime program, Lime was created in 2013 to help finance renewable energy and energy efficiency measures for non-owner occupied multifamily affordable housing of 5 units or more. It's been successful over the many years, and we're going to be going over the current position and facility performance in a couple of slides. So I will just jump into a couple of quick hits on the Lime facility itself. The Green Bank has a $6.5 million non-revolving term loan commitment to C4C that is paired with $1,090,000 from IPC for a total facility of $7,590,000. We have security on the eligible Lime programs with repayment of monthly P&I payments at various interest rates based on different loans, which we'll get into a little more detail on the next slide. And importantly, the availability for the Lime loan is rapidly approaching. And to that end, we are seeking approval today for a couple of different things. An extension of the availability period to end in a year from now, so the end of March 2027. In addition to the extension, C4C identified some proposed changes to the Lime program that would better serve the markets that they have access to as a CDFI. And as part of this request, we, the Green Bank, are proposing a modification to the facility structure and interest rate in efforts to simplify it. I think we can go to the next slide. Great, thank you. There are 5 changes to the program structure proposed by C4C. First is to the number of units in a multifamily property. They're looking to reduce that from 5 or greater to 2 or more, still focusing on non-owner occupied. Then the second is to the income limits, which had been expanded to market rate, and they are proposing to limit to low income as defined by the CDFI funds target market eligible with low income target population investment area. That is a guidance provided by the U.S. Department of Treasury's CDFI fund, and it helps CDFIs identify target market types for their investments. Third is a change in the loan rate to remove the rate requirement and price loans according to the minimum required DSCR. And then the fourth and fifth changes are to underwriting. For energy savings, they are looking to change from an energy service coverage ratio with varying coverage to an SIR of 1x. And then in terms of the debt service coverage ratio, they are proposing a change to break out for for-profits and to nonprofits. So for for-profits, it would be 1.2x and nonprofits is 1.1. Are there any questions on this before? Okay, we can move on. Sure, we have a question. Joanna?
Oh, can you hear me now?
Yes.
Okay, great. I was wondering if lowering the number of the units would have any other implications relative to other financing structures that might be involved in the funding, because there might be other programs that requiring it being 5 and above.
That is a great question. So currently, Capital for Change does have another program, the landlord loan, that does cover 2 or more, but that is restricted in terms of how it is restricted in the cap of how much money you can do for projects. So I believe their cap is around 40 to 45,000. Whereas the Lime loan, you can have it's a much higher rate. We've had there have been projects of $1 million done. And then I think their goal with reaching down to 2 or more was they have a lot more access to that market rather than 5 and above. Did that help?
Yes, it does help. I guess I was just wondering if the original structure might have been designed to be 5 or above because it was complementing other affordable housing type funding mechanisms, or maybe it's as simple as just trying to get to focus on that market. So thank you. It did help.
Any other
I was
questions
just going
or
to add,
observations?
I was just
Go
going to add,
ahead.
Joanna, that sorry, Chair Reed. I was just going to add that it doesn't mean that they won't be doing 5 or greater.
Yeah.
It just is it's broadening the array of property types that and situations that they can apply the Lime loan to. So it's a little bit more flexible. Thank you.
Thank you.
Anybody? Oh, go ahead.
Great. Then next up is the Green Bank's proposal for the Lime facility structure. Currently, there are 3 notes associated with the Lime with varying rates and the same availability period, which, as mentioned, we're approaching at the end of this month. The Green Bank is proposing to simplify this by setting the rate for loan A and B to 3.5%. And letting loan C availability lapse as IPC has not indicated they wish to continue participation. So we'll be focusing on the loan A and B and extending that availability.
Yeah, in fact, there will just be one tranche. It'll basically become just the loan facility. There will be no need to split into an A or a B. Go ahead, Fiona.
Great, thank you. And for this, I will turn over to my colleague, Christina.
Great, thank you, Fiona. Good morning, everyone. Just wanted to give the board a sense of where this facility currently stands and the performance of it over time as part of this request to extend the maturity and modify the facility. So to date, the Green Bank has advanced around $4.5 million of this facility to Capital for Change to support the origination of 5 underlying Lime loans. which leaves a little over $2 million remaining available for future originations. And currently the facility is approximately 65% repaid and will continue to amortize until the principal is fully paid off, which is currently expected to be around 2030. The facility is also really well collateralized. So the total receivables to Capital for Change on the 5 underlying Lime loans are 1.2 times the outstanding balance that Capital for Change owes the Green Bank. And these underlying Lime loans have been performing really well. There's been no history of delinquency from any of the borrowers. Capital for Change as an organization has also been performing well to date. According to their fiscal year 2025 audit, which is from the end of March 2025, they were in compliance with all of the financial covenants of all outstanding loans to the various lenders that they work with. And the Green Bank internally has been closely monitoring the performance of Capital for Change and of this facility specifically with quarterly compliance testing, and will continue to monitor the facility's performance moving forward. So as of the last quarter that we tested, which ended on December 31st, 2025, Capital for Change was passing all of the Green Bank's financial covenants, the most notable being the DSCR, which was 1.29 as compared to our required 1.25 on this facility, which demonstrates that the principal and interest payments that Capital for Change receives on these 5 underlying loans exceed the amount that they pay the Green Bank back in principal and interest on this facility on an annual basis. Another covenant is a loan loss reserve requirement, and Capital for Change has adequately set aside reserves that meet the Green Bank's minimum requirement. And for these reasons, we feel comfortable recommending the extension and modification of this facility and welcome any questions from the board.
Any questions? Do I hear a motion to approve resolution 3?
I'll make
So
that motion,
moved.
it's Joe.
Mr. Joe, and do I hear a second?
I'll second it, John Harity.
Thank you, John Harity. All in favor?
Aye.
Aye.
Opposed? Abstaining? Okay. Moving on. So 5B, or no, 5C, Capital for Change. I guess also that'll be Fiona and Christina again.
Yes. Sounds great. All right. I will, we've already covered C for C, but I'll give a little bit of an overview on CFCO. And so CFCO is a wholly owned subsidiary of C for C, focused on investment in energy efficiency loans, mainly Smart E loans. Smart E is our residential loan program that enables homeowners to pay for upgrades that reduce energy usage and improve property resiliency. We've partnered with 14 different community banks and credit unions to offer these affordable interest and unsecured loans. 7 of those lenders are actively participating. The Green Bank is not only the administrator of the program, lending implementation and technical support, but also financial support through loan loss reserve. C4C had been one of the largest Smart E lenders, but exited the program in late 2023. As we look at the CFCO facility, this facility was a $15 million medium-term revolving loan to CFCO. It is a joint facility as it was paired with another $15 million from Amalgamated Bank for a total facility of $30 million. I just want to note that the $15 million from Amalgamated is senior to the Green Bank. The loan is secured by all the loans made by the borrower and repaid as interest only at 4%. And we are rapidly approaching the maturing date maturity date in mid-April for this facility. In conversations with C4C and Amalgamated, it was agreed that both the Green Bank and Amalgamated would seek approval to extend the maturity date of the loan for 30 months with scheduled principal payments. And so that is why we're here this morning, to seek approval for that extension. And I'll turn it over to Christina to cover the position and performance of the facility.
Thank you, Fiona. So as of December 2024, the CFCO facility was fully drawn on. And since then, Capital for Change has been quite aggressive in making payments towards the facility. They've paid it down by 50% just over the past year, which leaves us with $7.5 million outstanding. And Amalgamated Bank also has $7.5 million outstanding as well. And this facility is also well collateralized. So the total CFCO receivables to Capital for Change, net of any loans that are currently delinquent, are almost 2 times the outstanding balance on both the Green Bank and Amalgamated's debt combined. So even if all delinquent loans were to be charged off, both lenders would still have plenty of collateral on this facility. And C4C has not had any history of delinquencies on payments to the Green Bank or Amalgamated for this facility, as they have not on the Lime facility as well. And I mentioned previously as well that they are in compliance with the covenants of all of their loans to all lenders as of the date of their 2025 financial audit. And as we do with the Lime facility, the Green Bank is closely monitoring the performance of the CFCO facility as well, with quarterly compliance testing and monthly reporting on delinquencies. So as of the last reporting period, so the quarter ending December 31st, 2025, C4C was failing one of the 3 financial covenants on this facility, which was the charge-off rate. It was 4.3, which exceeded the maximum allowable rate of 3.5. But this was due to a kind of mass cleanup of chronically delinquent loans that C4C did in November of 2025. And the Green Bank is comfortable issuing a waiver for this quarter, given the fact that they were passing all other financial covenants and are taking action to reduce delinquencies moving forward. So they're onboarding a loan servicing platform called Concord to more effectively manage their payments. And they're also bringing on an external collections agency to assist with recoveries. So we don't expect delinquencies to materially increase moving forward. And as Fiona mentioned, Capital for Change expects to make monthly principal payments of $250,000 towards this facility for both the Green Bank's portion and Amalgamated's portion, which should result in the loan be fully paid off by November 2027. They came to this number based on monthly receivables that they receive on CFCO loans and anticipate being able to make even larger payments in the earlier months, which should result in the facility being fully repaid even sooner. And for these reasons, the Green Bank recommends approval of this extension as well and welcomes any questions. Yes, John.
I might have missed it within the slide, but what is the dollar value of like delinquent loans?
So currently, let me pull it up. It is, as of the end of January, it was $1.6 million delinquent. So that means, I think 30 days or more overdue. So that's 6% of the entire portfolio.
And is that like, has that gotten more so or less so over time? I mean, is there more delinquency at this point than there was at an earlier time?
I think it's been decreasing since they've been taking a more active role in charging off kind of chronically delinquent loans, but I can let Priyank add some more color to that.
Thank you, Christina, and good afternoon. This is Priyank Bhakta on the investments team. So John, to answer your question, I would just remind everyone here that C4C categorizes loans as delinquent when they're 30 days past due. However, there is still a possibility that they would be able to recover some of those delinquent loans utilizing this new servicing platform that they're using. And in addition to that, to answer your question about historical delinquencies, it's actually a little bit difficult to answer that question because it does fluctuate from month to month. As you could appreciate, John, the underlying loans, I believe there are over 3,000 individual underlying loans for this portfolio. And the FICO scores and borrower profiles vary greatly. So it could be a situation where, for a few months, the underlying loans are actually performing really well. And then there may be certain months where loans may be underperforming for a short period of time, but then they will become non-delinquent through the efforts of C4C and the servicer that they're utilizing.
So it's not the case that like we're seeing like a sinking ship or anything like that.
That's correct, John. Yes, we're not. And
Cut
as
to the
Christine
chase,
also
John.
mentioned,
Yeah, that's, I mean, bottom line, right?
Yeah, come on. Bring it.
yep,
Well, thank you.
exactly. You're welcome.
Any other questions or observations? Do I hear a motion to approve Resolution 4?
So moved.
Thank you. Do I hear a second?
Second, Adrian speaking.
Thank you, Adrian. All in favor?
Aye.
Aye.
Okay.
Opposed? Abstaining? Okay. See, now we go to item 5D. And I think who is that? David is going to talk to us about that?
Yes, thank you, Jerry.
That's correct. Yep, David Beach,
Good.
you're up.
David Beach.
Hi there. Yeah, so I'm here to talk to you all today about a recent RFP that the Green Bank ran in search of a crowdfunding marketplace partner for the future of our Green Liberty Note program. For a quick bit of context, our Green Liberty Note program is the Green Bank's alternative to our Green Liberty bonds. These are investment opportunities that are more accessible to retail investors. Do not have to have a broker, and you can invest for just $100. Since the program started in 2021, we've raised more than almost $4.5 million across 15 issuances. That has come from 579 unique investors, probably 2x or more total investments. We've had a lot of investors who have found the Green Liberty Note program and really liked it. And when their note has repaid, they've reinvested into the next offering. Of those total investments, more than 60% have been in original increments of $1,000 or less, which really shows the benefit of this program and its ability to reach those smaller dollar investors. And about 50% of the investments have come from Connecticut residents. We've also received investments from over 40 states. So there's a lot of sort of broader appeal, but we've still had about 50% of those total investors coming from the state of Connecticut. So looking to sort of build off of that success, we are hoping to grow the program we are able to raise up to $5 million annually. That is a cap. So there is room to grow. And to do that, we are pursuing project-specific offerings, which align with our community engagement and market transformation and green investing goals. These are exciting offerings that would allow Connecticut residents to invest alongside the Green Bank in a project that is affecting and benefiting their local community, and perhaps even going a step beyond that to donate a portion of their interest to a local charity. We are also looking to attract greater investment from mission-aligned foundations. So to support this growth of the program, we submitted an RFP looking for a long-term partnership with a platform that would be best equipped to support those goals. And what we found was that Honeycomb Credit is the platform for us to do that. Honeycomb Credit is the largest debt crowdfunding platform in the United States. There are some larger equity crowdfunding platforms, but Honeycomb has really led on the debt side, which means there's strong alignment in just inherently in some of their investors and also how they've built their platform. We also specifically selected them for a few traits. First, they have a very sophisticated digital infrastructure, which means they are able to provide a great investor experience, able to be very helpful in terms of our offering documentation and submissions to the SEC, also significantly reducing the Green Bank's administrative burden by making the repayment process very easy, making the investor management process easy, even doing things like 1099 tax forms, making that process very easy, and not only easy for the Green Bank, but also for our investors. They also have expert staff. So they have on staff a chief compliance officer, which gives the Green Bank greater confidence to have another set of eyes to make sure we're not running afoul of any of the SEC regulations. They have a chief product officer, which is in line with some of their work, as I previously mentioned, on that back-end digital infrastructure. And they've shown a recent strong investment to continue improving their platform in that way. They also have a head of customer success, which is valuable for the Green Bank because we really want to provide a great service to our investors, and having someone who is like a dedicated expert to make the investor process easy, to handle questions and support on that end is really valuable. And last but not least, they have a really strong, extensive network already on the platform of those retail investors. You know, as I mentioned at the top, we created the Green Liberty Note program to go after some of the investors that we weren't reaching with our Green Liberty Bond program. And so Honeycomb is a place where a lot of those retail investors already are, and they've built a platform around supporting some of those smaller dollar investors. So for those reasons, we'd like to select Honeycomb Credit as our crowdfunding marketplace partner and work with them for the next 3 years. So I will pause, hand it back to you, Chair Reed, and be here for any questions.
Okay, do we have any questions? Observations?
I do. This is Kim from.
Hi, Kim.
Hi, David. In the context of the procurement processes of the state of Connecticut, and I was quickly trying to scan the memo that was in the board package and quickly trying to catch up on, everything here. Is Honeycomb the incumbent?
Yeah, we previously had worked with, the program originally started with a company called Raise Green. They were then acquired by Honeycomb.
Okay.
Brought,
there it is.
that back to the board a little over a year ago to work with them. And yes, they are the platform we have worked with previously.
I see. And did you get a lot of interest in this RFP? Were there other submissions?
Yeah, we reached out to 5 specific platforms. We had 3 express interest in submitting proposals. In the end, we only received 2. I would say there is a limit to the, total amount of platforms who I think can do a great job of supporting us in this effort.
Mhm.
But we were happy receiving the proposals we did, and the other proposal was a strong one.
So Ray's Green was acquired by Honeycomb, and you have since done one of these offerings with the new entity. Like there's been no issue with the
Correct. Yeah,
acquisition.
we've done, I think, 3 now issuances with them, have had a lot
Yeah.
of success. It's
Yeah.
been, I think, better than the previous platform was. A lot of that, some of the digital infrastructure backend things have been greatly improved, reducing some of the burden on our accounting and other sort of administrative staff.
Well, it's a pretty cool idea. Really, I don't know if it would work for the state's offerings, but it's pretty neato, as they used to say.
That's a
Thanks.
financial term, right,
Thank you.
Nito?
I think it is. That's absolutely true.
Just
Thank you for
building
answering
from
my-
that comment, Kim, the team has been working really hard. David, Bert, and our small business energy advantage team, which is the utility Eversource in this context, and Amalgamated Bank, to really support on an annual basis hundreds of efficiency projects for small businesses around the state. So, Gen 1 of our Green Liberty Notes was really about enabling local, people across the state, across the country to support, all of these small businesses. Now it's like, okay, how do we build on that and continue to enable people in our communities to come up with projects that they too can invest in locally? So
Yeah.
we're super excited by that
That's really
aspect of it. Some may choose to keep all of their returns. Some may choose to dedicate it to a local charity. We also want to bring foundations into the investment cycle here, where they would provide grants to local nonprofits. So Honeycomb just, David and crew ran the RFP. In the end, having the innovation be able to go further with our citizens to invest in local projects is the type of Series E war bond, types of activity that we're trying to work towards to enable everybody to invest in this economy. So yeah, it's cool. All those sorts of things.
The $100 denominations is quite foreign to me. We have $5,000 denoms in the tax exempt. Anyway, I'm done. Thank you for answering my questions.
Are there any more questions or observations? Okay, hearing none, do I hear a motion to approve Resolution 5?
I so move.
Thank you. Do I hear a second?
Join all second.
Thank you, Jim. Okay, all in favor?
Aye.
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 Opposed? Abstaining? All righty. Okay, so we're moving on. Let's see, 5E, a Webster Bank line of credit. I think Larry's going to talk to us about this.
Yep, he'll be taking over to drive us through this final presentation. Thanks,
Okay.
Larry.
Thanks, Bert. Thanks, Chair Reed. I'm coming to present to the board today to discuss a new line of credit for $5 million proposed with Webster Bank. Give a little bit of history on the SL2 and how we have used multiple facilities to operate this group. Back in 2018, the board approved a warehouse facility with Webster, the same bank that we are proposing today, and Liberty as a warehouse. So from 2019 up until last year, we used this revolving credit warehouse facility that was secured by our SHRECs, the solar home renewable energy credits. And that warehouse facility helped fund cash flows while we were preparing for our next tranche. So each tranche of bonds that we would issue. The Green Bank would become more liquid, and then we would help pay down that warehouse facility. We would repeat that over the course of 6 bond issuances, including our Green Liberty bonds. The last bond was issued last year in October. There was no balance on that revolving credit facility, and we terminated it because we weren't going to be issuing bonds anymore. So there was no need for that. In addition to that revolving credit facility, there was a line of credit with Key Bank that was started in 2013. That gave short-term liquidity beyond the scope of the Shrecs. So we also, in addition to the Shrecs, have lease and PPA receivables. And at any given time, there can be a short-term cash need in this facility because there's so much activity. If everyone paid everything exactly on time and everything always happened exactly to plan, you wouldn't necessarily need that. But in practice, there is a need for a short-term line of credit. That was prepaid in December of 2025. So as part of this SL2 facility, we did have 2 revolving credits, a revolving credit and a line of credit associated with this, and now we have none. So it leaves us with a need for short-term credit. You can go to the next slide. Oh, well, one note I want to say about Webster Bank also, besides, oh, you can go to the next one. One note I want to say about Webster Bank also, not only were they a good partner to us as part of the warehouse facility, just also note that they're headquartered in Stamford, Connecticut. So what we propose is a short-term facility that is interest only. It is the only short-term facility. It's the only facility that we believe will be connected to the Solar Lease 2 company. And we will likely need this a low amount. We don't forecast that we'll need it at all right now, but it's good to have this facility for any needs so that we aren't in a cash crunch if something unforeseen happens that could last a month, that could last 2 months, we don't know, but it's a good idea to have access to this cash for Solar Lease 2 in case we need it. And like I said, it's interest only. We will only pay the interest, which right now, it's based on SOFR, right now would be 5.45%. It will renew every 364 days. And if we don't use it, we won't be paying that interest. But it would help us if we found ourselves in the Solar Lease 2 facility to need cash. You can go to the next slide. The resolution, it has a lot of words on it, so I just want to point out why this is fairly complicated. So the reason is because this concerns the line of credit. So basically, we're asking you to approve this new facility, but the reason for so many words, just to help make it a little more layman's terms, is that one, we're asking you to approve this line of credit for the company, which is Solar Lease 2 LLC. So it's not for the Green Bank, which adds an additional level of complication. And then in addition to that, there's a guarantee associated with it from the Green Bank, and the guarantee is signed by our officer. So you just have a couple layers in there, which is why there's several resolutions on this slide. But all of these together are asking you to approve this $5 million line of credit for Solar Lease 2 with Webster Bank. And if you have any questions, please.
Any questions or comments? Okay, hearing none. Do I hear a motion to approve Resolution 6?
So moved.
Thank you, John. Do I hear a second?
Joe will second.
Okay, thank you. All in favor?
Aye.
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 Opposed? Abstaining? Excellent. Okay. So I think I see other business, 5 minutes. Brian, did you want to talk about that?
Yeah. So we have 2 items on other business. And Lonnie, maybe I'll set some context here on Matt, and feel free to speak to the award you provided to him earlier this week. So we are organizing a celebration for Matt's service to the predecessor of the Green Bank, the Connecticut Clean Energy Fund, to the Connecticut Green Bank, and his service to the state of Connecticut. So more than 15 years of serving on the various boards to advance clean energy in our state. So we'd invite all of you as members of the board to join us for that celebration. It's going to be right here across our parking lot here at the Capewell Lofts Club. It's going to be great, good time celebrating Matt, all the things, appetizers, beverages, dinner, special guests, short speeches. We're trying to bring in some oldies here. Fingers crossed we can get some historical players here, but so just putting that on your radar screen. And let me see if, Lonnie, you had anything else you wanted to say about our great Matt Ranelli here.
I mean, when you think about us being the first Green Bank, the state Green Bank, to come into existence, and just the risk management part of that, and to look at his resume and the kinds of things that he's done. He heads the environmental division of what is it? The big law firm, one of the big ones.
Shipman, yeah.
Shipman and Goodwin, and he's. And I was saying, thank goodness he was on the board, because we couldn't have afforded him. When you look at what he's Lawyer of the Year, and national standing, and all this kind of stuff. But the other thing that's been so great about him is whenever you need him, I mean, he can be in the middle of something else. He can be getting on a plane or off a plane, and sees that the Green Bank is calling, and immediately picks it up and listens and advises. And so he's just been remarkable, and we want to celebrate him. I should also say that there's going to be a band, and so it's going to be a very lively, fun evening, and I hope everybody comes. Brian?
Awesome. Thank you, Lonnie. And then on our comprehensive plan, so we're in that period of time of the year where we're looking ahead, and we're looking to organize a strategic offsite retreat. So stay tuned. Cheryl may be sending notes out on your Thursday and Friday availabilities in the coming months. We're looking for, probably a day-long session somewhere special to cover a lot of different things. Thank you, Adrian, for reaching out and asking about, would we look at future presentation of the state of the economy to the board. So we're thinking about how to pull that in along with the various policy shifts at the state and federal level, whether those are pushing us towards our back or holding us back as a headwind. And then talking about, some new things looking ahead for 5 years. So stay tuned for that. And then thank you to all of you on the various one-on-ones. We've got Lonnie and I reaching out to many of you. We'll be with many of you in your areas. We had a meeting earlier this week with James Cosgrove, which is super fun. And some of the things we'll be talking about when we connect with you are, the committee assignments that you're on. How are you feeling? Where might things be going? So to just have a conversation there. Obviously, a lot is going on, as James talked about, on the state policy front. There's also stuff going on at the federal front. How is all that impeding or advancing our progress? So we'll talk a little bit about that. And then we'll give you a sense as to how this comprehensive plan is going. Sarah and Eric on our team are leading the way here. So I'll provide an update on the process and timeline there, some initial findings, and then some questions to talk about, which fun lunchtime conversation, I guess. But, what areas should we be doubling down on, and what are the greatest opportunities to expand our impact? So again, thank you all for making that time. We're looking forward to visiting you in your various necks of the woods and in the coming months ahead. So stay tuned for a note from Cheryl to see if we could find a Thursday or Friday date in the coming months for all of us to get together.
Hey, Brian.
Please, John.
Yeah, just in terms of kind of looking ahead and looking at the broad picture, I think it'd be really good to look at what other states are doing as well.
Yeah.
To kind of, hopefully identify some best practices from different places. There's a lot of work being done on the state level now because the federal government is, moribund on this stuff or antagonistic. So, I know of coalitions in at least a dozen different states that are being aggressive on climate, and I don't know that we always hear about all that stuff.
BG, can I jump in?
Please.
Thank you for that, John. And that is something that we're looking at. I had to catch up a couple weeks ago with New York Green Bank, and last week Bert and I attended a regional gathering of green banks from Mid-Atlantic and New England to share best practices, talk about what we're focusing on, talk about common needs and challenges. And I think we identified a bunch of areas that we can work together on, either to work jointly or to dig in deeper and share best practices. So I hear you on that, and that's something that is on our radar, and we will continue to do.
That's great. Just because we're not hearing about climate in the news these days doesn't mean that it is not relentlessly going forward.
That's right. That's right.
Very true.
Great. Okay, thank you. Those were some other business items.
Okay. Well, it looks like we've come to adjournment, and if does anybody want to just hang out for another 3 hours or whatever? Wishing everybody a fabulous weekend, and may I hear a motion to adjourn?
So moved.
Thank you. Second?
I'll second that, Adrian.
Thank you. All right. Should we vote?
Right.
We shall.
All in favor?
Without
Aye.
objection.
Aye. Okay. Okay. We're adjourned. Thank you, everybody.
Great weekend, all.
Thanks all.
Bye.
guys.
Happy spring.
Fingers crossed.
Yeah, may it keep up.